Hello, this is ChewDog Charts, and today's video is titled Teddy Bear Market. And I titled it Teddy Bear Market because it's just so soft and cuddly. It's as if the powers that be don't want you to get hurt. So we had a big correction in the market in early February, but that's forgotten, and we're now on our way up. The central bankers have revved up their printing presses, and money is raining on stocks. It makes it very hard to sit on the sideline with cash ready to go while the stock party continues on. So in today's forgiving market, we're going to take a quick look at the money coming in, a quick check on the Fang stocks, and then we're going to take a look at the Bank of America's dreaded bear market indicators, or should I say teddy bear market indicators. So let's take a look. And this chart here shows you what I was talking about with regard to easy money, with the central banks continuing their money printing. And as this shows, mid-morning on Monday, all but 3 of the indices were green. And that's because the European Central Bank continues their quantitative easing at 30 billion euros a month. And then over the weekend, the Bank of Japan's Kuroda announced persistent monetary easing is needed. And at the same time, China injected 150 billion won in overnight liquidity. So what do you get? You get green. I don't know, there's 1, 2, 3 indices that are down, and I don't know why those are losers, but everybody else was green. Let's go to the next chart. And then, of course, the ever-present margin debt, which has been increasing year after year after year. And this from the Financial Industry Regulatory Authority, or FINRA. The most recent information shows that as of December 2017, total margin debt is now at a record $642.8 billion. Again, money is raining on the stock market. Let's go to the next chart. And to check in on the Fang stocks, this may be of interest to any of you that hold any of the Fang stocks, which are Facebook, Amazon, Netflix, and Google. There was a study done in mid-2015 that was comparing the relative performance of the Fang stocks and in comparison to the original 4 horsemen of the dot-com era, 1995 through the year 2000, right before the dot-com bust. And the 4 horsemen were Cisco, Intel, Microsoft, and Qualcomm. They were the poster child stocks for that period. And this chart here shows the Fang stocks with their time frame on the bottom from 2012 into 2017. However, the study was done in 2015, mid-2015. And the timeline on top, that's for the 4 original horsemen for the time frame of 1995 to the year 2000. So when this study was originally done in mid-2015, showing the relative performance was pretty close. There seems to be a relatively decent comparison on the performance in the initial, say, 3.5 years. So now let's go take a look at the update. And this chart here shows the update on the study completed 2 years later. And again, the Fang stocks in the blue on the lower time scale and the 4 horsemen on the upper scale. And so one would ask, can the Fang stocks continue to run? Well, the answer would be yes, and it wouldn't necessarily be unprecedented. And as you can see here in the chart, following the brief consolidation at about 1998, the 4 horsemen had run about 500%. They had a 500% rally up until about 1998. But then they would embark on a further 400% rally over the next 2 years into the year 2000, which was the top of the bubble, the dot-com bubble. So perhaps these Fang stocks have more to run. Let's go to the next chart. And this chart here shows the aftermath of the dot-com bubble, where the four original horsemen declined by about 80% into the year 2003, following the bust there in the year 2000. So, is the same thing going to happen for the Fang stocks? Well, we don't know, but at least the moral of this story is not every market is a soft, cuddly teddy bear market. We're going to keep our eye on this, and we will find out soon enough. Okay, let's go now to the bear market indicators from Bank of America. And this chart here shows the Bank of America bear market indicators. And currently, there are 19 available signals, and 68% or 13 of those have been triggered. If you remember, about a month ago, just as the S&P was hitting its all-time high, and we talked about this, Bank of America announced that one of its proprietary guaranteed bear market indicators, which was created by their quants, was just triggered. And what was remarkable about this particular indicator is that it predicted not only the size of the upcoming drop, but also the timing. And it was uncannily accurate. And apparently, it's been accurate 11 out of 11 previous occasions when it's triggered. And part of that is that this crash indicator or bear market indicator was triggered when 11 of the 19 so-called broader bear market indicators had been triggered. So now today or recently, Bank of America is reporting that 13 of the 19 bear market indicators are now flashing red. So of those available signals, 13 of those are flashing red, and that makes it 68%. And in order to get to that next trigger mark, or 80%, two more of these indicators have to be triggered. So is that going to give you enough time or not? I don't know, and here's why. Look back here in November of 1968, there were only 5 available signals. In January of 73 and November of 1980, there were 6 available signals. It went up to 13 in August of 1987, 17 in July, and in March, July 1990 and March of 2000, and then up to the 19 in October of 2007 and currently. So I don't know what signals were triggered back in 1968, 73, 80, 87. But right now, if 13 of those signals have been triggered, then we're probably skating on thin ice. So I would suggest that if you're out there trading, just be cautious, because even though it might be a teddy bear market, nice, soft, and cuddly, soon it may turn into a real bear market. So for today, that's ChewDog Charts. Thank you.